The scariest AI model of the year made Wall Street richer and Main Street angrier.
What is Mythos?
Mythos is designed to find security flaws in software.
Too powerful and dangerous to be released to public.
The CEOs of the biggest AI companies are messaging their technology as incredible and potentially world-ending.
If we have like an offense-dominant situation, we could have a situation like nuclear weapons, but like more dangerous, right?
The doomsday pitch is landing like a thud with consumers, but investors are loving it. If Wall Street is right, AI stocks could keep propping up your 401k. But if consumers are right, the AI bubble could be set to pop. So who's right? I'm Mady Mills, a senior AI reporter at Axios, coming to the beat after nearly a decade covering Wall Street. So let's follow the money together to get the answer. Let's take a look at the stock market, which you may have noticed keeps hitting all-time highs despite a slew of risks.
It appears the latest round of ceasefire talks between the U.S. and Iran have failed before they even started.
Per usual, the rally can be attributed to tech, but this time the buy signal came from the AI labs themselves. JP Morgan says the current rally kicked off the same day Anthropic announced its new model, Mythos. Mythos is the AI Anthropic deemed so powerful, so dangerous, they only gave it to a handful of trusted partners. The pitch landed so hard that Washington officials invited a slew of bank CEOs for an emergency meeting about protecting financial infrastructure from Mythos. When an AI lab tells you their model is too dangerous to release, investors don't hear the danger. They hear competitive advantage. The more terrifying the model, the bigger the moat around the company. The bigger the moat, the bigger valuation. But there's one major problem with a trade built on fear. It only pays off if that fear turns into revenue. A small group of public tech companies are spending nearly $700 billion on AI this year. To justify that, AI has to generate real returns. And right now, the math is ugly. For starters, there's no clear end in sight for AI CapEx. That's the amount of money companies have to spend to keep up in the AI race. And it just keeps growing and growing. That's where Wall Street giant NVIDIA comes in. They keep producing better, more efficient chips. That may sound great, but in reality, it means tech companies can never catch up because they keep having to buy these chips that, yes, are getting more efficient, but they're also getting more expensive. Uber's CTO already burned through his entire 2026 IT budget on AI tokens. That's the cost of AI usage. NVIDIA's VP of Deep Learning told me that the cost of compute is already outpacing the cost of his employees. So basically, this means that some of the biggest tech companies are already spending more on AI than human salaries. And the price of AI is going up, not down. OpenAI and Anthropic have been subsidizing your cheap ChatGPT and Claude subscriptions in the same way that Uber was subsidizing your $8 ride to the airport when that company first started. This is the Silicon Valley playbook. It's also called the venture capital subsidy. Get you hooked and then raise the price. Anthropic already started doing this for its business customers. And both companies are barreling towards IPOs where shareholders are going to demand continued growth, which means higher AI prices for you and pressure on the margins of every public company spending big on AI use. So if AI is just going to be another huge bill for corporate America, it's not clear that it's worth all this hype and all of this cash. Meanwhile, customers are turning on these AI labs.
The founder of OpenAI under attack today after police say somebody threw a Molotov cocktail at Sam Altman's home.
Half of Americans say they're more worried about AI than excited, and Gen Z's excitement about the technology sits at just 22%. Negative AI vibes is one thing, but that sentiment could be a real problem when it turns into pushback for data centers that are needed to power and train AI models. And that's already playing out.
Happening now, people in Saline Township protesting a massive new data center project.
Michiganders taking their opposition against data centers straight to the steps of the Capitol.
Say they'll also be impacted by this massive data center, and they're not happy about it.
In 2025, 48 data center projects worth over $150 billion were blocked or delayed. And in Missouri, voters ousted half of the city council to stop a $6 billion data center project. The AI labs are selling fear to Wall Street, and while investors are eating it up, consumers are getting sick of it. Unless those everyday consumers are retail investors clamoring to get their hands on private shares of AI companies. OpenAI is increasingly courting the retail crowd to increase its shareholder footprint. Enter Robinhood, the famed retail investing platform. Robinhood's venture fund recently closed a $75 million investment into OpenAI, giving retail investors access to those shares before the company goes public. No minimum investment or accreditation required. So the same people who might lose their jobs to AI, who increasingly hate it, and are having to pay higher subscription prices, can now buy a slice of the company doing it. Some retail traders have told me they actively want to buy shares of AI companies as a hedge against their own jobs being replaced by AI. The idea, if AI is going to replace me, at least I'll benefit from the upside that creates for the stock market. So to answer our big question, who's right? Wall Street is betting on what AI could become, and consumers are reacting to what AI is today. Those are two very different stories that have opposite outcomes for the market. Let us know what you think in the comments.